The potential impact of the U.S. debt ceiling on the markets has been a topic of discussion recently. The debt ceiling is the limit on the amount of debt the U.S. government can issue to fund its operations. If Congress fails to raise or suspend the debt ceiling, the government would face a risk of defaulting on its debt obligations. This, in turn, could lead to significant economic and financial consequences. While inflation has been a concern for investors lately, the debt ceiling issue could become more important in the near term. Some market participants believe that the debt ceiling is a more pressing issue than inflation right now, as the potential impact of a default on U.S. Treasury bonds could be catastrophic for the global financial system. The U.S. Treasury has warned that it will run out of cash to fund the government's operations by mid-October unless the debt ceiling is raised or suspended. The clock is ticking, and investors are keeping a close eye on the situation. If Congress fails to act, it could trigger a sell-off in U.S. Treasuries and other assets that are perceived as safe havens. This, in turn, could lead to higher borrowing costs for the U.S. government, as well as for companies and individuals. The potential ripple effects of a U.S. debt default are difficult to predict, but they could be far-reaching and long-lasting.